Today, we are going to move away from the Canadian banking sector and take an interesting look at some banks down under. Fasten your seatbelts, folks. This is going to be a good one. Today's video is our first subscriber-sponsored video, so a huge shout out to FunnyBooks for this requested deep dive. The ETF that FunnyBooks wanted me to do is the Hamilton Australian Bank Equal Weight Index ETF, which has a ticker of HBA. This ETF invests in an equal weight share of the big 5 Australian banks. This instantly gives you some great international exposure. But what exactly are you investing in? I think before we can review this ETF, we need to look at the Aussie banking sector in general. The Australian banking system shares many similarities with Canada's, making it somewhat familiar to Canadian investors. Both countries have well-regulated, highly concentrated banking sectors dominated by, well, a few large players, ensuring stability and reducing systematic risk. They even have their own version of the Bank of Canada in their Reserve Bank of Australia. The RBA tightly supervises the sector and controls interest rates, well, just like our Bank of Canada does. Their current rate is sitting at 4.35% at the time of recording. They did not lower their rate at their last meeting, and they're not expected to lower it at their September 24th meeting. It has been steady at this rate since November of 2023, when they finished their rate hike cycle. Now, we did talk a little bit about similarities, but there are some key differences between Canada and Australia as well. Australia's economy, for one, is more tied to global commodity markets, especially mining, and its housing market plays an outsized role in its banking profits. The Australian system also has fewer large banks, making it even a little bit more concentrated than Canada's. So who are the big 5? Starting with the biggest, the Commonwealth Bank of Australia has a ticker of CBA, and they have a market cap of $239 billion. Interestingly enough, they are in a similar boat to TD, as they also had some issues with money laundering and the fines that come with it. We also have the Westpac Banking Corporation with a ticker of WBC. By the way, all of these banks are on the Australian Securities Exchange. So their market cap, it comes in at $109.78 billion. There is also the Australia and New Zealand Banking Group with a ticker of ANZ and a market cap of $94.11 billion. Next, we have the Australian Bank with a ticker of NAB and a market cap of $119.69 billion. Lastly, we have the Macquarie Group with a ticker of MQG and a market cap of $81.78 billion. Whew, speaking of banks, a sub to the channel is a great way to bank some future content. I do like how Hamilton approaches their ETFs, and this one is no exception. Their strategy of equal weighting these banks rather than a capitalization weighting really does create a much more balanced investment. Part of the allure of this ETF is, of course, global diversification, and this ensures we are getting a good sampling of Australia's banking sector. Of course, the proof will be in the pudding, so we should jump in and check out some of those numbers. If we are talking digits, we need to call on the most significant digit I know, and that mighty number-slinging math wizard himself, Mr. Math. We will begin with a little surface data. At the time of recording, their share price was coming in at $28.48, which exactly matches their NAV, which is also $28.48. Their net assets under management, that's coming in at 141.22 million, and they have a beta of 1. So they are pretty much exactly as volatile as the market average. Their price to earnings ratio, that comes in at 18.33. They have an average volume of 2,087. We can see that this is not a huge volume ETF, so that is always a consideration if you're a shorter term trader for sure. Their return on equity, that comes in at 12.37%, and they have a return on assets of 0.80%. These numbers look fine, and even the average volume is, well, it is what you would expect on an ETF of this nature. Let's peel back another layer and take a look at their fund specifics. We'll, of course, start with the fees. Their management fee, that comes in at 0.55%, and they do have a management expense ratio of 0.70%. When it comes to rebalancing, this is a semi-annual rebalanced ETF, meaning they go in twice a year and they adjust their numbers to get them back to an equal weighting. Looking at their holdings, we have Westpac Banking Corp at 21.1%, Commonwealth Bank of Australia at 20.8%, National Australia Bank at 19.9%, Macquarie Group at 19.3%, and ANZ Group at 18.9%. One of those questions I know I'm going to be asked, so we're going to just include it here today, is how are these dividends taxed? Okay, if we look at their breakdown of 2023 dividends, 53.83% of that was considered foreign income, 46.16% was considered capital gains, and 0.01% was return of capital. Whereas foreign income is taxed fully. This is an ETF I would throw in a registered account if possible, even if it's just to avoid the headache of figuring out the taxes. I do like what we are seeing so far, and I can't wait to see what sort of returns we are getting with this ETF. We will, of course, start with their dividend. They do have a yield of 4.346%, quarterly dividend of 31 cents per share. Now, they've only been around for just over 4 years, as they came into being back in June of 2020. In that time, their dividend has grown from 24 cents a share to 31 cents per share. They have also been providing an extra special dividend each year, usually in January. So that's not too shabby either. Looking at their returns, on their 3-year, their return on investment came in at 25.74%. Factor in the dividends, we get a total return of 48.08%. Looking at the 1 year, their return on investment comes in at 32.10%. Adding in dividends, we get a total return of 39.02%. On their year to date, that return on investment comes in at 27.77%. And that's a total return after we add in some dividends of 31.69%. Holy banana bread, that's not so bad. That's pretty good. These are some great looking total returns for sure. I mentioned that the proof is in the pudding earlier, and well, this pudding is pretty delicious. This is an ETF that I think is not a bad choice, as not only is it giving you a very good total return, it is also adding some global diversification to your portfolio, and that's not a bad thing. The only real downside with this ETF is that low volume, which is only really a concern for short-term traders. If you are looking to make fast profits, this ETF is probably not for you. Also, pure income investors may also pass on this one, though if there was a covered call version, yeah, there's not. Unfortunately, long-term investors, this is a great ETF. And in my opinion, it is more than worth taking a look at. If you are interested in HBA, don't forget to put in a whole heaping helping of due diligence before you place any of your hard-earned money on the table. Let's continue that learning journey by checking out this video on XEQT. Thank you for watching, and I will see you in the next video.